Why hedge funds are record short Treasury bonds like TLT. As stock market fighting the Fed blindly. In more than 15 years trading and covering markets, never have I witnessed a market fighting the Fed as boldly as this one. Even as one Fed speaker after another preaches higher rates for longer, bond traders continue to price 10-year treasuries 200 basis point below, where the Fed says the overnight rate must ultimately be. Not just in bonds. Stock investors are now on board. Just from January alone, year to date. Growth stock like Open Door Technology has went up more than 80%. Tesla went up 40%. Nvidia went up 30%. As TLT went up 7% and S&P 500 went up 6%. Why is the market so confident? One phrase, irrational exuberance. Why hedge funds are record short Treasury bonds like TLT, as stock market is fighting the Fed blindly. I will explain it all right after this. And of course, smash the like button. If you want to be my good boy, apply to write your first book with me. Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here. And you know what to do. And push my button if you like what you see in today's video, because I can't push it from this side. This video is brought to you by my Patreon. If you are a good boy, go to patreon.com/magicalgoddesscheryl to add more meaning into your life. If you play your cards right and completely submit like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get it into the bookstore. You want it to be real. You want it to be true. You need to be my client, don't you? Irrational exuberance was the phrase used by then Federal Reserve Chairman Alan Greenspan in a speech during the dot-com bubble of the 1990s. That phrase sent markets in a panic, widely interpreted as a warning that the stock market might be overvalued. However, since the speech in December 1996, the S&P 500 is up more than 400%, proving the phrase marked the ultimate buy the dip moment. If the Fed is incorrect and the market is right, rates will have to come down later this year, making bond and stock traders correct in this debate. So why does hedge funds record shorting Treasury bonds like TLT? 2023 started with a buying panic in bonds, approaching their best start to a year in over 30 years at one point. As confidence grew about the Fed's terminal rate, not as high as some feared, and a soft landing, growth cooling, and inflation slowing. But as the last week's surge in positive macro data, driven largely by better than expected labor market prints, we have seen bonds sold and stocks bought, and hedge funds have piled in, building the biggest bearish bet on bond futures on record. An aggregate measure of net short non-commercial positions across all treasuries maturities has hit 2.4 million contracts. According to the latest data from the Commodity Futures Trading Commission, as of January 24th, the positions covered a multitude of investment strategies from outright bets to yield curve wagers, to relative trades to hedges. But the overall direction clashes with the narrative that a peak in rate hikes is near, and a U.S. recession will push investors back into bonds. The surge of bets against treasuries may be driven both by the risk for a hawkish Federal Reserve meeting and also the longer-term concern that a soft landing would mean higher yields. If the U.S. economy can thrive in the face of the tightest hiking in recent history, then that should mean we end up with a higher neutral rate and a re-steepening of the yield curve. Perhaps even more notably, short-term interest rate markets are starting to print out a dovish Fed in the second half of 2023. Since January 19, 2023, cut expectations have dropped from 54 basis points to 40 basis points. As the chart shows, the terminal rate remains relatively well behaved, below 5%. 59 basis point of hikes priced in from here. But expectations for a pivot from the Fed are starting to fade, even as stocks squeeze higher on the same hope. More in favor of a pause, as the Fed's dots and jawboning signal. Fed fund futures, however, show money market traders aren't fully convinced the rate will top 5%. Perhaps more galling to the Fed officials, traders expect the central bank to deliver cuts by year end. Stock market investors have also bought into the latter policy pivot scenario, fueling a January surge for beaten down technology and growth stocks, which are particularly interest rate sensitive. Treasury bonds have rallied, pulling down yields across the curve, and the US dollar has weakened. Cruising for a bruising. To some market watchers, investors now appear way too big for their breeches. They expect Powell to attempt to take them down a peg or two. How so? Look for Powell to be unambiguously hawkish. Hawkish is market lingo used to describe a central banker sounding tough on inflation and less worried about economic growth. In Powell's case, that would likely mean emphasizing that the labor market remains significantly out of balance, calling for a significant reduction in job openings that will require monetary policy to remain restrictive for a long period. If Powell sounds significantly hawkish, financial conditions will tighten up quickly. Treasury yields would rise, tech would drop, and the dollar would rise after a message like that. If not, then expect the tech and treasury rally to continue and the dollar to get softer. Hanging loose. Indeed, it's a loosening of financial conditions that's seen trying Powell's patience. Looser conditions are represented by a tightening of credit spreads, lower borrowing cost, and higher stock prices that contribute to speculative activity, and increased risk-taking. which helps fuel inflation. It also helps weaken the dollar, contributes to inflation through higher import costs. Indexes measuring financial conditions have fallen for 14 straight weeks. Powell and the Fed have certainly expressed concerns about the potential for loose financial conditions to undercut their inflation-fighting efforts. The minutes of the Fed's December meeting, released in early January, contained this attention-grabbing line. Participants noted that because monetary policy worked importantly through financial markets, an unwarranted easing in financial conditions, especially if driven by a misperception by the public of the committee's reaction function, would complicate the committee's effort to restore price stability. That was taken by some investors as a sign that the Fed wasn't eager to see a sustained stock market rally, and might even be inclined to punish financial markets if conditions loosen too far. Data showing U.S. inflation continues to slow after peaking at a roughly 4-decade high last summer, alongside expectations for a much weaker and potentially recessionary economy in 2023, have stoked bets that the Fed won't be as aggressive as advertised. But a pickup in gasoline and food prices could make for a bounce in January inflation readings, which would give Powell another cudgel to beat back market expectations, easier policy in future meetings. Jackson Hole Redux. I see the setup heading into this week's Fed's meeting as similar to the run-up to Powell's speech at an annual central banking symposium in Jackson Hole, Wyoming last August, in which he delivered a blunt message that the fight against inflation meant economic pain ahead. That spelled doom for what proved to be another of 2023's many bear market rallies, starting a slide that took stocks to their lows for the year in October. In any case, I see weakness in the economy will manifest in companies' earnings this year. It's unavoidable. It's coming. This is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is an erotic novel, such an amazing book. Order your copy for Valentine's Day. And my book, Rainbow Focus. So to order a copy for Valentine's Day, the link will be in the description below to place your order for Valentine's. It does make an awesome Valentine's Day gift. You are such a good boy for watching my video right till the end. Bye.